You just found the house. The one. You call the agent, ready to make an offer, and they ask you one question that stops you cold. Are you pre-qualified or are you pre-approved? You say pre-qualified because that's the letter sitting in your inbox. The agent goes quiet for a second. That quiet is the sound of a deal slipping away. Here's the part almost nobody explains clearly. Pre-qualification is a guess. You tell a lender your income, your debts, your rough credit score, and they hand you a number based on your word. No documents, no verification, just a conversation and an estimate. Pre-approval is different. A lender pulls your actual credit report. You hand over pay stubs, tax returns, bank statements. An underwriter looks at the real numbers, not the ones you remembered off the top of your head. What comes out the other side isn't a guess. It's closer to a promise. Why does this gap matter so much? Because in a competitive market, sellers know the difference even if buyers don't. A pre-qualification letter tells a seller you probably can get a loan. A pre-approval letter tells them a lender already checked, and the money is very likely there. When two offers land on the same day, the seller isn't choosing the higher price. They're choosing the one that won't fall apart in 3 weeks. Think about it from the seller's side for a second. They've taken their house off the market. They've mentally moved on. The last thing they want is to restart the whole process because a buyer's financing collapsed at the finish line. Pre-approval is the thing that tells them that won't happen to them. There's a reason so many first-time buyers get this backwards. Pre-qualification feels like progress. It's fast, it's free, it's often done in 5 minutes online. So it feels like you've done the work. But that speed is exactly what makes it weak. A real underwriter hasn't touched your file. Nobody has verified a single number. Picture two buyers walking into the same open house on a Saturday morning. Both love the kitchen. Both can picture their furniture in the living room. Both go home and write offers that same night. One attaches a pre-qualification letter, generated online in the time it took to make coffee. The other attaches a pre-approval letter, backed by an underwriter who has already looked at real pay stubs and a real credit pull. On paper, their offers might even be the same price. But the seller's agent has seen this movie before. They know which one is more likely to actually close. That's not a guess on their part. It's pattern recognition built from watching deals fall apart. And deals do fall apart, more than buyers realize. A financing contingency exists precisely because lenders sometimes discover, deep into the process, that a buyer's real numbers don't match what they assumed. Debt they forgot to mention. Income that's harder to verify than expected because it's commission-based or self-employed. A pre-qualification letter can't catch any of that because nobody ever looked. A pre-approval at least puts those surprises earlier when there's still time to fix them, instead of 2 days before closing when a moving truck is already booked. There's also a psychological side to this that's easy to miss. Walking into a negotiation with a pre-approval letter changes how you show up. You're not hoping you qualify. You already know within reason what a lender is willing to hand you. That confidence tends to show in the offer itself. Buyers who are still guessing at their own numbers often hedge, lowball, or add contingencies out of nervousness. Buyers who've already been vetted tend to negotiate like they belong at the table, because a lender has already told them they do. So what should you actually do? Get pre-qualified early when you're just starting to figure out your budget. It costs you nothing and gives you a rough sense of what's realistic. But before you ever walk into an open house ready to compete, get pre-approved. Pull the real documents together. Let a lender actually check your credit and your income. That's the letter that gets you taken seriously. There's a subtlety here too. Pre-approval isn't a guarantee either. Your financial picture still has to hold steady between now and closing. Lenders recheck things right before you sign. Open a new credit card, finance a car, change jobs, and that approval can shift under you. The number on the letter is only as solid as the life you keep living underneath it. Buyers learn this the hard way more often than you'd think. Someone gets pre-approved in March, spends the next 2 months house hunting, and celebrates finding the right place by ordering new furniture on a store credit card. That new account shows up on a credit pull the lender runs just before closing. Suddenly, the debt-to-income ratio that made the loan work no longer adds up the same way. The lesson isn't complicated. but it's easy to forget in the excitement of finally finding a home. Pre-approval is a snapshot, not a lifetime guarantee. Keep your financial picture as boring as possible until the keys are actually in your hand. So here's what to remember. Pre-qualification is a conversation. Pre-approval is a verification. One tells a seller what you think is true. The other tells them what a lender already confirmed. In a market where good houses move in days, that difference decides whether you get the keys or you get the polite email that says they went with another offer. You called the agent ready to make an offer on the one. Now you know exactly which letter gets you in the door.